Hello. Very divine greetings of this joyous and refreshing evening to all of you. Dear guys, I, Kunal Nagpal, am feeling immensely pleased to welcome you all to this great forum wherein we discuss the core matters of strategic concern, helping us to enhance our overall understanding for the Indian economy, wherein we take very important dynamics, trying to elaborate the topics at the best possible manner in order to develop the proper understanding of the matters which are of crucial importance in the today's scenario specifically, because we need to be well aware. Being the responsible citizens, it's our moral responsibility to be actually well aware and well versed with the developments taking place across the globe, especially with those developments which are affecting the overall functioning of our own economy. Correct? So, in these sensitive times existing in the global scenario, we are observing a lot of fluctuations occurring with respect to the inflation dynamics, supply chain dynamics, not only for a particular country but across the globe. Now, all these things are actually very interrelated. And how to seek balance among these parameters is the main objective of any economy functioning worldwide. And this actually depends on the overall methodology a particular economy is adopting for seeking that point of equilibrium. The way in which the strategies are being devised, the overall framework is being carried on, the priorities which are being set by the economy, depending on its core innate strengths, depending on certain weaknesses which may actually prolong or delay the attainment of that equilibrium point, they need to be considered corresponding to the opportunities and threats being presented by the external environment. Now, as I have been saying in all my sessions, that the leading economists and the respected ministers of various countries always say that the only way to succeed in the persisting times is actually your overall skill to take the best advantage of the crisis in terms of the opportunity. That is the way you are able to identify the opportunity in the current periods of crisis is your basic skill. That determines how dynamic leader you are, how charismatic leader you are. And that basically deals with resource optimization. We can't blame the situation why it is so. But the way in which we deal in the current situation with our available resources, keeping in mind to take the maximum advantage of your core innate strengths, is the real way to be successful, right? So, in today's session, I would like to elaborate on the inflation dynamics pertaining to the Indian economy, and we are also going to take the holistic view of the global economy, wherein we are going to consider certain aspects of the US Federal Reserve. And along with this, we are also going to consider the present scenario in the Indian economy, that is how it is trying to seek the balance between inflation objective and the growth objective, that is the minimization of inflation, to make it possible under the band of 4%, to make it come to the threshold of 4%, though 6% is the threshold limit, but still our RBI governor is trying his best efforts to bring it to 4%. Simultaneously, the objective of the government is also to maximize the growth. So we are going to discuss the current status as per the latest statistical reports. That is, what's the current status in our economy. So let's begin. Now, dear friends, before I begin my discussion on inflation dynamics for the Indian economy as well as for the global economy in the current sensitive times, I would like to throw some light on the level of forex reserves for our economy. Actually, India's foreign exchange reserves fell by $1.268 billion in the first week of the year itself to $561.583 billion. Now, if we further bifurcate this particular level of forex reserves, that is analyzing the trend of its respective components. Let's see. The foreign currency assets, the major component of the forex reserves, fell by $1.747 billion, while the reserves held in gold rose $461 million. The Reserve Bank of India data showed. My dear friends, we had discussed in actually one of our preceding sessions that the performance of the gold reserves is actually quite favorable for our economy, and that's what has been presented here. That is, the reserves held in gold rose $461 million as per the RBI report. So the fall in foreign currency assets was perhaps on account of the central bank's dollar sales to support the rupee. The forex dealers said. RBI did not give the reasons behind the rise or fall of reserves. So this is actually very well justified that the fall in the foreign currency assets was actually perhaps on account of the central bank's dollar sales to support the rupee. So that's the real game, my friends, in order to seek the balance between inflation and growth. So now, after developing the comprehensive understanding of the level of forex reserves which is existing in India as of now, let's move forward to discuss the inflation dynamics. Actually, inflation steady beyond the forecasts can make the policy more effective. The study of the asymmetric distribution of inflation, especially during the periods of uncertainty, should be carried out in addition to the forecasting of movements of the gauge to ensure a more effective monetary policy narrative, a Reserve Bank of India research paper suggested. So this suggestion is actually of paramount importance because it is suggesting that in the times of crisis, when the times are quite unstable, if we talk about the global economy, and obviously India is the part of the global economy, so any fluctuation occurring in any part across the globe would definitely have a considerable impact on our economy. Hence, we should design our policies and the overall framework of the economy should be in correspondence with the fluctuations occurring in any part of the globe. So that's what they are saying. That is, during the times of uncertainties, the study of asymmetric distribution of inflation is actually preferable. So, the asymmetric nature of future inflation distribution may be useful in explaining the tail risks of inflation and also in helping the monetary policy in communicating the balance of risks, it said. In India, the volatile food prices and global oil price shocks impact the CPI movement, that is the Consumer Price Index movement, significantly. Moreover, during the extreme events such as the global financial crisis and the COVID-19 pandemic, it actually becomes very difficult to predict the trajectory of inflation due to the uncertainties surrounding it. So, in such circumstances, the distribution of future inflation, in addition to the inflation forecast, may be very useful for the future guidance, particularly under a flexible inflation targeting framework, the paper said. The conventional approach assumes symmetric distribution of inflation, which may not always hold, the paper argued. So here we are trying to develop the understanding that what should be actually practiced, that is, what kind of approach should be actually practiced during the uncertain periods. That is, in the realistic scenario, when we are observing a lot of fluctuations in various economic parameters worldwide, we should not adopt the symmetric distribution of inflation, which is actually being practiced as per the conventional approach. So this is the basic argument raised by the RBI paper. So let's discuss a particular example here in order to develop a more effective understanding of this particular concept. So, for example, food is a major component of the consumer price index basket in India, while the food prices typically face higher volatility owing to the supply side issues as well as the monsoon dependence. Similarly, the high dependence of India on crude oil imports makes it prone to any global oil price shock. I hope these examples of the food sector and the fuel sector make the overall issue being raised much clearer, right? Nevertheless, the tail risks of inflation, that is the upside and the downside risks to the consumer price index, that is the CPI, has moderated in India since the country adopted the flexible inflation targeting regime in 2016, said the research paper co-authored by Silu Muduli and Ms. Himani Shekhar. The upside risks to the CPI headline inflation in the country have declined to 6.5% over the past 6 years from double digit in the preceding period, while the downside risks to inflation have increased and have remained around 1.5%. The inflation targeting central bank is actually mandated to keep the inflation at 4% with a band of 2% on either side of it. This gives the monetary policy maker the flexibility to balance between the economic growth and inflation control objectives. That's the main gist as we had discussed in the beginning of our session. That is to seek the balance between economic growth and inflation control objectives. This is the basic goal for the proper functioning of an economy. And all the efforts are being inclined to this particular objective. Now, what are the key takeaways? The volatile food prices and the global oil price shocks impact the CPI movement. During the extreme events, it actually becomes very difficult to predict the trajectory of inflation. As per the conventional approach, the symmetric distribution of inflation is actually considered. The upside risks to the CPI down to 6.5% since 2016 from double digits earlier. The downside risks to inflation up and have remained at 1.5%. Now, if we consider the overall statistical analysis for the consumer price index for the year 2022, we basically note that in the month of April 2022, the CPI was at the level 7.79%, and it underwent various fluctuations in the subsequent months. However, the figure recorded in the month of December 2022, that is the last month of the year, it went significantly low, that is 5.72%, which is the least CPI level for the year 2022. So this is really a very, very favorable trend. Now, my dear friends, let's move on to basically enhance our understanding of the concept of the actual scenario prevailing in our economy as of now with regards to inflation and industrial growth. So the good news is inflation cools and industrial growth bounces back. In the twin relief for the India's economy, the retail inflation eased more than expected to a 12-month low in December, which we have just discussed. That is 5.72%, while the industrial growth swung to a 5-month high in November from a contraction in the preceding month. The separate data releases on Monday showed. The positive data mix raises the odds that the Reserve Bank of India may pivot its monetary policy from fighting inflation to supporting growth amid a worsening global economic outlook. The retail inflation, as measured by the Consumer Price Index, eased to 5.72% in December from 5.88% in the preceding month, that is November 2022. Within the RBI's target band of 2 to 6%, as the lower vegetable prices eased the food inflation. This is really a very, very positive news. On the other hand, the index of industrial production, that is IIP, rebounded to 7.1% growth in November from a 4.2% contraction in October. Again, this is really another good news. The World Bank said on Wednesday that the global economy is actually perilously close to falling into recession. Yes. The overall global economic scenario is quite gloomy, and that's what has been mentioned here. That is, as we have been discussing in our previous sessions as well, a global recession is actually being predicted in this year itself. The retail inflation is now within the RBI's target rate band for the second month running. But despite the rebound in November, the economists expect the industrial growth to actually struggle in the face of higher interest rates and an adverse global economic environment. So this is a very, very delicate phase we are going through, because we are one of the very significant components existing in the entire global economy. And keeping into consideration the very important fact that the global economy is actually becoming more and more unstable. So, though the industrial growth statistics for the month of November 2022 are quite favorable, but still we should try to maximize our growth, and that can be attained if we pay less emphasis to monetary tightening, because we have attained significant progress in the overall curtailing of inflation as depicted by the statistical figure of December 2022, that is 5.72%. This is my personal view. So, taking into account today's lower than expected CPI inflation print and the muted average IIP growth of 1.3% during October to November 2022, we anticipate that the Monetary Policy Committee, that is MPC, may choose to pause in February 2023. In terms of further rate hikes, there may be a pause. That's what has been commented by Ms. Aditi Nair, Chief Economist, ICRA. The next monetary policy announcement is actually on February 8, after the budget for the financial year 2024 is presented on February 1. So, from the policy perspective, we believe that RBI's move at the February MPC meeting will be a close call, with core CPI inflation remaining sticky, said Ms. Rajni Sinha, Chief Economist, CARE Ratings. India Ratings Principal Economist Mr. Sunil Sinha expects a 0.25 percentage point rise in the policy rate at the February review. So here we see that various economists are giving their viewpoints or giving their projections, that is, what may actually happen on 8 February. The Reserve Bank of India raised the interest rates by 35 basis points to 6.25% on December 7, following 3 successive 50 basis points increases to tame inflation. A basis point is actually 0.01 percentage point. Industry wants the RBI to pause the rate increases. As per Mr. Saket Dalmia, President, PhD CCI, we are hoping that there will not be any further increase in the policy repo rate, as this will have a considerable impact on demand creation and economic growth in the country. Inflation in food and beverages was at 4.58% in December 2022 against 5.07% in November. The decline in the index for the vegetables deepened to 15.1% in December against an 8.1% fall in the trailing month. So, the overall softening is largely attributed to the decline in the prices of the vegetables that helped offset the rise in costs of other products of the food basket, such as cereals, milk and meat, said Sinha of CARE Ratings. Further, if we talk about the fuel and light inflation, it was actually at 10.67% in December 2022 against 10.62% in November. inflation is actually expected to gradually ease in the coming months, but an adverse base effect may push it up in January. So, although food inflation has declined, the worrying trend is actually continuous increase of cereals and products inflation, which is trending upwards from May 2022, and in last 3 months it has remained in double digits as per the statistical reports, said Mr. Sunil Kumar Sinha, principal economist at India Ratings and Research. The rating agency further expects the retail inflation to drop to about 5% by the first quarter of the financial year 2024. So this is also again a very encouraging projection. All three industrial sectors, that is electricity by 12.7%, mining by 9.7%, and manufacturing by 6.1%, contributed to the strong recovery in November. The industrial output basically rose 1% in November last year. The overall industrial production growth in April to November period was 5.5% against 17.6% a year ago. The capital goods output, an indicator of investment, grew 20.7% in November, while the consumer durables production rose 5.1%, indicating a pickup in urban demand after contracting in October. So the growth got a boost from the base effect. The growth in the consumer goods, however, comes over the negative growth rates last year, as does the capital goods, said Mr. Madan Sabnawis, chief economist at Bank of Baroda. However, the festival season demand did add to the impetus given by the base effect. The consumer non-durables output firmed up 8.9% after a double-digit decline in October. Moreover, the erosion of household income due to high inflation, rising interest rates, and tepid global demand are actually expected to weigh on growth going ahead. So, Nair said the on-year growth of most available high-frequency indicators moderated in December. So in line with this, we expect the overall IIP growth to moderate to low single digits in December 2022. Now, what are the key takeaways from this particular write-up? Inflation seen around these levels before easing the next fiscal. The industrial rebound not seen sustaining. A lot of factors happening in the global economy are quite responsible for this particular scenario. And high inflation, rising interest rates, and tepid exports to drag down the demand. Now, if we consider the statistical analysis for the industrial pickup, so for the November 2022 statistical figures, in manufacturing it was 6.1%, in mining it was 9.7%, electricity 12.7%, capital goods 20.7%. Consumer durables 5.1%, and consumer non-durables 8.9%, which we have discussed in our discussion in this particular regard. Moreover, let's now proceed to another write-up in this particular regard, wherein we are going to go through the insights presented by Dr. Shaktikant Das, RBI Governor, who basically thinks that the global rates could be high for long. All thanks go to the global uncertainties existing worldwide. So, India's central bank governor Dr. Shaktikant Das on Friday said that the interest rates globally could remain elevated if the current geopolitical tensions were to continue, although the odds have lengthened on the likelihood of a hard landing and subsequent recession in the United States of America, which might instead escape with just a dent to its growth prospects. The Reserve Bank of India, mandated with the task of maintaining the broadest price gauge within the 2 percentage point trimlines of a 4% target, is actually not comfortable with sticky core inflation prints at 6%, Mr. Das said at a financial industry event in Mumbai. I repeat, as per Dr. Das, the Reserve Bank of India, mandated with the task of maintaining the broadest price gauge within the 2 percentage point trim lines of a 4% target, is actually not comfortable with the sticky core inflation prints at 6%. So, if the geopolitical conflicts continue the way they are, if there are new flashpoints, it could actually be a situation of high for long with regard to the interest rates the world over, Dr. Das said. I told you, my dear friends, the upcoming times are actually going to be more sensitive. He further adds that RBI is actually keen on ensuring core inflation is not sticky at uncomfortable levels of 6%. But optimal supply chain management has brightened the prospects for moderation in inflation globally, he said. So this is the favorable factor, that is optimal supply chain management, which is actually helping to deal with the current crisis. The cooling inflation has improved the overall economic outlook in the world's advanced economies, according to the RBI governor. 6 months ago, the expectations around global recession were quite grimmer than they are today. Everyone thought there would be a recession in the European Union, said Dr. Das. I'm not ruling out that particular possibility, but it has improved considerably. It looked as if the United States will face a recession, but it may also avoid that, facing instead a growth slowdown. Slowing inflation has prompted several economists to forecast an imminent end to the US Federal Reserve's rate tightening cycle, hauling Wall Street indices from 52-week lows. Lately, the technology-heavy Nasdaq, the stock gauge most battered by Fed's liquidity drainage, has climbed about 8% from lows on expectations of a pause in the rate cycle by the summer. The supply chain efficiencies should actually increase the likelihood of further moderation in the global inflation. That's what is being highlighted again. That is, the supply chain efficiencies are acting as the positive factor to deal with the current crisis more effectively. There could be a moderation in inflation numbers going forward. It also depends on the depth of the slowdown that the countries are actually going to experience, he said. Dr. Das further said that despite the geopolitical tensions, several large economies had managed to streamline their supply chains. Notwithstanding the geopolitical issues, every country, every system knows how to adjust to a new situation, he said. The global supply chains have considerably eased out. The countries are looking at new sources of supply now. there is this whole talk of China plus one as well, which we have been discussing in our sessions. That is China plus one. So after going through this very, very broad-minded perspective of Dr. Shaktikant Das, let's try to understand and let's try to develop the basic framework of how the Federal Reserve, the US Federal Reserve, should talk about inflation. So this article is actually based on the suggestions or on the advice, that is how the US Fed should talk about inflation while making its projections. So the United States of America inflation slowed again in December with luck, bringing forward the point at which the Federal Reserve can safely stop raising the interest rates. It's actually a good news, but it complicates one crucial aspect of the Fed's job, as the gap between what the central bank says it will do and what the financial markets think it will do threatens to get wider. The consumer prices actually fell last month by 0.1 percentage point compared with the month before, thanks mainly to the lower energy costs. On a 12-month basis, inflation slowed down from 7.1% in November to 6.5% in December. The core inflation, excluding the food and energy, fell to 5.7%, the lowest in more than a year. Most notably, the prices of the so-called core services, which the US Federal Reserve is known to watch closely as a measure of underlying inflation, are also rising more slowly than before. None of this should actually come as a great surprise. A sharp decline from the earlier peaks in 12-month inflation rates was actually baked into the numbers because of the sudden acceleration of prices early last year, and there is likely more to come. The question is whether, without further increases in the interest rates, this trend would eventually push inflation all the way back down to the Fed's target of 2%. So, as the things stand, that still looks unlikely. With unemployment at just 3.5% and employers struggling to fill the vacancies, the labor market is still exceptionally tight. The wage inflation appears to be slowing but is still substantially higher than before the pandemic. So, reconciling a red-hot labor market and strong consumer demand with 2% inflation would be quite a feat. I repeat, reconciling a red-hot labor market and strong consumer demand with 2% inflation would actually be quite a feat. It certainly is not to be counted on. Granted, slowing inflation tightens the monetary policy in its own right by raising the real, that is inflation-adjusted interest rates. The Fed will actually need to take this into account. Nonetheless, recent statements by the chair, Jerome Powell, and other officials affirming the need to raise the policy rate by at least another half point seems warranted. The growth in wages has to subside more convincingly before tightening can actually safely stop and go into the reverse. So in this regard, the new data do support a slower pace of interest rate increases. Many forecasters expect the next one to be 25 basis points and not 50. But it is still too soon to declare this battle won. And this is being said because of the gradually intensifying uncertainties which are having a very, very unpredictable nature. As far as the war in Ukraine and Russia is concerned, and also the after effects of the ongoing pandemic is concerned. So these times are quite sensitive. Therefore, it's really still too soon to declare the battle won by the US Federal Reserve. In the meantime, the Fed faces a communications dilemma. Despite the central bank's messaging to the contrary, many investors still expect it to start lowering the rates before the end of this year. Perhaps the Fed agrees, but if this actually became its declared intention, the yields would likely subside, asset prices would rise, and financial conditions would ease, all serving to lessen the downward pressure on inflation more on the central bank might wish. So, the investors understand that the Fed therefore has an incentive to mislead them about its true intentions. So merely by promising to keep the policy tight in the future, the US Federal Reserve keeps the policy tighter now and improves the chances that it will indeed be able to relax sooner. So this is the basic communication gap. So this paradox of forward guidance is all too familiar to the central bankers and not easily resolved. The more the central bank relies on seeming to make promises about the future, the more often it will find itself tempted to mislead. This in turn risks causing the investors to pay less attention to its supposed commitments, including its most important commitment, which is actually to get the inflation back on target. So the best remedy is actually straightforward. That is, the central bank should focus attention on the current data and how its policymakers understand it, and less on how the policy might change months from now. So, with the conditions as disrupted and unfamiliar as they are today, that is something neither the Fed nor those who pore over its very announcement can actually know. So, this particular advice to the US Federal Reserve, that is how it should actually convey its message, how it should actually talk about inflation, is actually very, very insightful. So, my dear friends, after having developed the thorough understanding of the current dynamics of inflation existing in the Indian economy, and also having developed a very in-depth analytical viewpoint about the global economic situation with regard to inflation and the growth, keeping in view that these times are quite uncertain, we are in a position to actually conceptualize this particular subject and try to understand the moves being taken by our government bodies in this particular regard. And this particular matter is a crucial concern for all the citizens, since we are residing in this economy. We should be aware that how is the inflation, that is the rise in the price levels, actually being operated. We should actually have this understanding in our minds, the basic framework, the basic the entire mechanism in which this entire process works. It is very important. Then only we will be able to conceptualize and understand why the government is acting in a particular manner, why the central bank is acting in a particular manner. Our questions would come down, our doubts would get lowered, our queries would get answered. This is very important, not only for the economists, not only for the leading pioneers of the country. It is important for every citizen of the country. So, on this note, I would like to conclude today's session, and I really hope that you all are actually developing a very, very clear concept with proper understanding of these core subjects. And for that, you need to take down the notes, jot down important points. Whatever point you find relevant, note it down. It is very important. So, dear guys, it was really a pleasure to interact with you once again. It was really a very great opportunity for me as well to conduct such a knowledgeable session. And please subscribe to my YouTube channel so that you keep getting updated about the economic news we are discussing on this amazing platform. Thank you so much. Namaskar. Jai Hind.